Good afternoon and Happy New Year to everyone. Thank you for joining us this Wednesday afternoon for our very first exclusive webinar for 2021. My name is Carlos Navarro and I will be your host and moderator for this interesting talk. Today, we are very fortunate to be joined by two financial experts who will share with us some of their insights on their outlook for 2021. But before we move on, just a few reminders for our attendees. First, everyone will be placed on mute for the duration of the program. Second, should you have any questions, feel free to type them in the Q&A chat box found at the right-hand side of your screen. You may do so even while the presentation is ongoing, as we will go through each and every question during the Q&A portion after the presentation. Now, I know you're already all excited to know what's in store for us this 2021. So without further ado, for our first speaker, to talk about the local and global investments in 2021, a seasoned economist with over 20 years of professional experience, having worked in Singapore and New York before settling back here in the Philippines to serve as the Senior Vice President and the head of the Metrobank Trust Banking Group. Please welcome Mr. Dondi Santillan.
Good afternoon, everyone. Thank you for joining us for today's webinar. We will discuss our outlook for 2021. The key takeaways for this webinar is first, to highlight that growth in 2021 will be slow and uneven. Second, that the BSP action is pushing interest rates lower. And third is the asset allocation path, or what we suggest in terms of allocation for the different asset classes. I wanted to highlight this page now. This is the GDP numbers, GDP standing for gross domestic product, or basically the production of the Philippines. We hit a high note in 2019 at 19.5 trillion. Take note that 15 years or 18 years ago in 2002, that was just 2 trillion. So we've grown a lot in the last 20 years. And this is the highest we ever reached for the country. This is basically the production of the whole country. However, because of what happened last year, the pandemic, we fell into a recession. We fell to 17 point, well, we expected to fall to 17.4 trillion. If you look at the graph below, or the chart below, our expectation for 2020 is negative 10%. That's after growing 6% for the last 3 years. So the question is, are we going to recover pre-pandemic levels? The problem is, we don't think it's a V-shaped recovery. We think 2020, at least based on our expectation of a growth of 6.4%, we will end at 19 trillion, even lower than the 2019 level. So basically what happened last year was we erased almost 2.5 years of growth. 17.5 is somewhere between 2017 and 2018. That's how devastating the pandemic was for our economy. And unfortunately, we feel that we will not break that high point of 19.5 this year. We probably will hit around 19 trillion. Hence, what we expect is more a hockey-shaped recovery rather than a V-shaped recovery. We expect that we've seen the worst in 2020. 2021 can't be any worse. Take note, in 2020, the economy was practically shut down for almost 9 months with various versions of ECQ and GCQ. To understand better GDP, or gross domestic product, the components of gross domestic product is 72.6% on average over the last 5 years based on consumer spending, and 11.6% on government spending. When you say government spending, this is the infrastructure projects the government gets into. When you say consumer spending, it's what we actually purchase in the marketplace. So basically what I'm saying is for us to reach pre-pandemic levels, I guess we have to each ask ourselves the question is of whether we feel comfortable going back to malls, whether we feel comfortable going back to restaurants, whether we feel comfortable going back to traveling as we did prior to 2020. And basically the answer is no, not in 2021. We will still see some backlash from the effects of the pandemic, at least for the first half of 2021. In terms of government spending, the government is geared on its build program, especially as we see 2022 as an election year, and normally during election years, the government starts spending again. So really the big question is consumer spending. What we also wanted to highlight is that growth is uneven. A big thing that's in the news right now are the vaccines. In the whole world, only 14% are wealthy nations, and 86%, which we belong to, is all other nations, or what you call emerging markets. The wealthy nations will get 53% of the vaccine, and the remaining 47% will be split by the 86 nations. So what we saw last year was we saw a big rally in developed markets or wealthy nations, equities markets last year, because they were anticipating that they will recover faster from the pandemic. Unfortunately, emerging markets or all other nations will not grow as fast, especially as we will have trouble getting vaccinated this year. On the second point, what we wanted to highlight was what we call easy money. Basically, to spur the economies, since most economies last year were in recession, including the Philippines, central banks around the globe were seen cutting rates to support the economy. So what happens when they cut rates is, so if you see here on the left-hand side, this is developed countries, UK and US as an example. US dropped interest rates from 1.75% down to 0.25%. The UK dropped from 0.75% down to 0.10%. We have countries like Japan that are almost 0% or negative interest rates, as well as the Eurozone. Likewise, for emerging markets, Philippines dropped rates from 4% to 2%, and Indonesia, as an example, dropped from 5% to 3.75%. The talk is, at least the US Fed said that they will keep rates low until 2022. So we expect interest rates to remain low for the next 2 years. Not only are they lowering interest rates, in the example of the Philippines, what they did was they also cut reserve requirements, meaning what the bank has to set aside for every deposit taken. They cut reserve requirements by 2% last year, which freed up a lot of cash or excess cash into the system. So what happens when we have what we call monetary policy or loose monetary policy? So in the case of the Philippines, the Bangko Sentral ng Pilipinas cut interest rates like I showed in the previous slide, no? And likewise increased money supply by decreasing reserve requirements of banks. In fact, right now, the amount of money being circulated in the system is in excess of 1.7 trillion. Only 5 years ago, that was only 300 billion. So there was a injection of almost 5 times extra money into the system. Theoretically, what happens is, if you lower interest rates and increase money supply, it should make it easier to borrow money or loans increase. So the idea of cutting interest rates is to spur loan demand so that companies can start investing in themselves and start increasing production, increasing employment, which will further affect consumer spending. As people are employed, they can spend more money going to Jollibee, going to restaurants. But in reality, what's happening right now with the banking system is, first, bad loans are up 77% last year. 77% seems like a big figure, but that's coming from a low base. The non-performing loans, or what we call defaulted loans, last year started at around 1.5%. Right now, they're at 3.4%. So it's a 77% increase, or an increase from 157 billion to 305 billion. In fact, a study made showed that there was a question asked, is it more difficult to borrow 50,000 now than it was in 2019? Most people said it is more difficult. So you would think with lower interest rates and with more money supply in the system, it should be easier to borrow. Unfortunately, because banks are saddled with bad loans, they don't want the bad loans to increase. So they're getting a bit worried about lending out too aggressively. But at some point, this should reverse, as banks have no choice but to start lending again and spur business. The problem with monetary policy, or what we call BSP action, is that there is a lag effect. It does not benefit the economy as fast as what we call the fiscal stimulus. So this is what you call monetary stimulus, where they lower interest rates and increase money supply. The fiscal stimulus is when they actually give out dole-outs. So why are banks having, or companies having, a tough time paying loans? Well, basically the business conditions during GCQ, 66% were temporarily closed. That was from July onwards. So more than half of the companies of 2019 were operational. Were not operational, rather. And the balance being operational. But even if they are operational, they were operational not up to 100%. Only 5% of companies that were operational were above 75% productivity, and 43% were 25 to 50%, and 36%, or one-third, is less than 25% operational. If you go to malls right now, you will notice that a lot of stores are still closed, a lot of restaurants are still closed. In fact, I read up something in the papers probably 6 months ago that said they expect 40% of restaurants to close. Well, we will see what the actual numbers are. This is what you call the fiscal stimulus. So this is the other type of help the government can make. The first part was to try to increase loans by lowering interest rates and increasing money supply. The second one is what we call fiscal stimulus. This is what the more developed countries are doing. So this is basically what we call ayuda, or what when the government actually gives money to the people so that they can start spending. When they start spending, people start getting jobs, and then it's a vicious cycle where the economy starts improving. If you look at developed markets, what they did was they allocated 11% of their GDP to fiscal stimulus. In Japan, in fact, they did 20.9%. The difference between emerging markets and developed markets is developed markets can borrow as much as they can to stimulate the economy. For us emerging markets, we have to limit our borrowings because one, our credit ratings will be affected. Two, we don't have the capacity to borrow as much as developed markets. So as opposed to the monetary policy, which is the BSP action of lowering interest rates, the fiscal stimulus actually impacts the economy faster. So that's why we expect developed markets to recover faster than emerging markets. So like I mentioned earlier, we expect low interest rates for the next 2 years, at least in line with what the Fed said, that they'll keep interest rates low until 2022. If you notice, when you try to place time deposit, interest rates are below 1%. you hardly earn anything. And this is the big problem. One is we do not earn enough from our investments in time deposit and bonds or fixed income securities. For instance, the 1-year yield is at 1.7. I mentioned time deposit rates are below 1%, and the 2-year rate is at 1.86. It's not only low interest rates that's a problem, it's also that inflation is higher. Inflation particularly is higher than the money we earn from bonds or time deposit. So in effect, what we really earn is 1.7 minus 2.7 expected inflation, negative 1%. So what does this negative 1% represent? This represents what we call real interest rates or real return. The net of your yield less inflation. Take note that the yield here is still subject to 20% tax. So you'll actually be yielding much lower than 1.7%, and inflation is higher. So what does this mean? What it basically means is, yes, your money grows by 1.7%, but what you don't see is the effect of inflation. We call inflation the invisible or the silent killer. People don't notice it. Over time, yes, your money seems to grow, but your purchasing power decreases over time. I have this favorite anecdote that I like to share with clients to highlight that. In the 1970s, my parents bought, or my dad bought, insurance for 1 million pesos coverage. Back in 1970s, 1 million pesos was a big deal. You can buy 5 big houses with 1 million pesos back then. Unfortunately, and this is a joke, he is still alive, and the 1 million coverage right now is nothing. It will not even buy you 10 square meters in a prime subdivision. So what I'm saying over time is inflation decreases your purchasing power over time, which is why we always say staying only in fixed income and time deposits is a dangerous proposition because you will not beat inflation. So there are two things that are happening right now. First is the low yield. Second is inflation is higher than that yield you earn. In fact, the latest print for inflation for December, which came out yesterday, was at 3.5%. So that's almost a negative 2% carry on 2-year bonds. So what we will see this year, we expect, is we will see a migration to stocks for higher return as people are forced and realize that the earnings from interest rates from bonds and time deposit is too low. So there will be a search for more return. And the only way you can get that here in the Philippines, at least with Philippine investments, is to migrate to the stock market or move some money into the stock market. So that should be beneficial for the stock market. Other things that favor the stock market right now is the foreign ownership. The foreign ownership of Philippine stocks peaked at 27.7% in the last 10 years. Right now, it's at a 10-year low of 22%. If the foreigners just need to buy stocks to go back to neutral, they will have to buy $8 billion worth of stock. So from a technical perspective, this is good because the foreigners have less to sell. They cannot afford to sell much more. So there will be less pressure from the foreigners selling Philippine stocks. So that should be favorable for the stock market. Second is what we saw last year, the transaction count of the PSE was an increase of 13.9%. Okay. Like I mentioned, foreigners were net sellers last year. In fact, the last 2 years. But what was surprising last year was online brokering, represented by call and FMSB increased 22%. So what we're actually seeing is an increased retail participation in the stock market, meaning the base of the stock market is increasing. More retail participation, and we expect that to increase more even this year. So again, this is favorable for the stock market because this is an additional new entrant into the market, the retail market or the retail investor. They were quite active last year. This is the consensus earnings for companies in the next 2 years. This was collated from Bloomberg. So earnings represent the earnings of companies as compared to the previous year. So for the UK in 2021, they still expect a decrease in earnings of 37%, but in 2022, they expect an increase of 7.3%. Among the countries here being represented, if you look at it, Philippines, the consensus or what market expects or what the professionals expect is we're going to grow by 32% earnings in 2021. Take note, the reason why the percentage is big is because we're coming from a low base in 2020 after the devastating effect of the pandemic, and a decent return of 13% in 2022, or total of 45% for the next 2 years. In fact, the best among the different countries represented here. So again, this is favorable. As earnings of companies grow, this should naturally translate into price appreciation of those companies. So that is from a valuation perspective. Philippines looks cheap at this moment. Which brings me to my last slide. In the first half of 2020, we were 21%. The recommended portfolio allocation between dollars and pesos was 21% in stocks and 79% in bonds. The reason we were favoring bonds at that time was because we felt monetary policy will favor bonds in 2020, which it did, and the slow growth or the slow opening of the economy will affect stocks. By the second half of 2020, we changed the allocation to 47% stocks and 53% bonds. So still a sizable amount in bonds, but take note, the reason why we're also bringing down that percentage is because, one, interest rates are so low. Two, interest rates hardly beat inflation. And the reason we favor stocks is we feel as the economy opens up slowly, the stock should benefit from this. So bottom line, the question is, when I started is, will 2021 bring us back to pre-pandemic levels of 2019, which was a peak for GDP? Like I mentioned, we don't think it will. We think the recovery or going back to pre-pandemic levels will be in 2022, which is why we said it was a hockey-shaped recovery. However, because of low interest rates in bonds and in anticipation of a better 2022, we tend to favor stocks more this year. Thank you.
Thanks a lot, Dondi, for that. As we gathered that the low interest rate environment of the BSP is meant to increase liquidity in the market, which will in turn stimulate the economy. And correspondingly, that this same low interest rate environment will make investors shift from the fixed income asset class to the equity space as investors search for higher returns amidst this low inflation environment, low interest rate environment. Once again, everyone, we'd like to remind everyone to please key in your questions already for the speakers. We will be addressing them during the Q&A portion after the presentations. So to move on to our next speaker, he will be sharing with us some of his strategies in order to ride the opportunities offered by the equity space, as Dondi mentioned a while ago. He is the Chief Investment Officer and currently oversees the investments in Metrobank's Trust Banking Group. He has been in the industry for the past 3 decades, 27 of which fortunately have been with Metrobank. So please welcome Mr. John Padilla.
Thank you for that very nice introduction, Carlos. Almost 3 decades, make that almost 3 decades. But thank you, Dondi, for that very interesting insight about the recovery that will take shape in our economy, in our country this year and beyond. Uh, for my portion, I will be highlighting what Dondi mentioned already. Essentially, the recovery story, and he mentioned about two important drivers of this recovery: consumer spending and low interest rates. She mentioned about it is time to go to the stock market, and we are firmer in our resolve that it is indeed time to go to the stock market. Forget the bad experience of 2021. That was in fact an opportunity for you to start your journey towards stock market investing. But it is not too late. We believe that the stock market will offer a lot of opportunities for us in the next 2 to 3 years. As they say, the stock market is essentially a leading indicator of the economy. From this chart, you can see the blue line would be your economic expansion. That's a GDP expansion from 1995. And the other line you will see is the PSEI. That's the behavior of the PSEI. And basically, it tracks the expansion of the GDP. This year or last year, we saw a very big recession, as Dondi mentioned, on account of the lockdowns. The economy was closed, businesses were on a standstill, and understandably, the market also had quite a big drop. Fortunately, we ended the year down by just about 8%, I believe. And we think that the trajectory will remain the same. It will merely validate that the stock market will follow where as the path of economic expansion continues to unfold. And this year and the next will be a recovery of that. I believe Dondi mentioned about the Philippine economy losing about 2 years or 2.5 years worth of its value. We will be recovering that. It will not happen immediately, but it will be on a consistent, steady path. As I mentioned, I will be talking about essentially lifting from the drivers of recovery that Dondi mentioned. First is consumer spending. He mentioned about something like 72% of our economy is made up of consumer spending. The Filipinos really love food. We love to dine out, meet with friends, coffee here, coffee there. Something that the pandemic took away. Prior to the ECQ, by the way, we'd like to show you this survey, an independent survey of one of our counterparties involving 3 companies: Jollibee, Max's, and Pizza, or Shakey's. Tells you that prior to the ECQ, 65% of revenues of these companies were derived from your normal dining. But the ECQ, the lockdowns, took away all of that. People resorted to either delivery or takeout. Upon easing of the restrictions by the IATF, it appears that some people, they still, half still were resorted to takeout or takeaways, but the deliveries was reduced to about 20%. And there was about 20% now people who were going back to restaurants. I think we should be thankful that this behavior actually did not result to a spike in cases. Again, no reason to let our guards down. We have to remain vigilant and careful, practice health protocols as we go out and do we try to return to our normal lives. People are social creatures. As much as possible, we want to go back to our normal way of life. Perhaps that has been changed already with the pandemic, but we are quite confident that the food business will remain a strong driver of the recovery story that will be unfolding this year and the years to come. Maybe let's take a look at how the food companies performed or behaved during the pandemic. we are highlighting Universal Robina, CNPF or Central Pacific, Jollibee, Maxis, and Pizza. The second column will show you how these companies ended 2020. And we are comparing the closing prices to their high prior to to COVID. URC lost about 33%, or is lower by about 33%. Central Pacific, which is a staple food, a staple product during the pandemic, was almost flat. It's almost flat. Jollibee is about 40% below. It's a high of 325 pesos. And Maxes is just about a tenth of what it used to be. And Shake is about half of what it was prior to COVID. Simple story, simple message. These share prices should retrace to this high, not this year, possibly next year and beyond. We have every reason to believe that while these companies are not likely to return, like Jollibee is not likely to return to 325 immediately, we believe that the process of recovery is already taking shape. Next, on consumer spending, still consumer spending, one thing that was really taken out of our lifestyle or our normal lives is shopping, retail shopping. I really couldn't imagine the Christmas season without shopping. And having gone through that, I'm thankful that we can survive. I'm happy that my wife didn't have to go through the malls every day during Christmas. But what this chart is telling you is the number of people who are slowly going back to the malls. Clearly, during ECQ, the malls were shut, except for the supermarket spaces in the malls. But for other shops in the malls, they were closed. But as the restrictions were eased, people started gaining the confidence. Perhaps, after having been holed in your home for the past 6 or 7 months, it's time to see a new place, or maybe your comfort mall near you. But again, thankfully, this trend has not resulted in a spike of cases. We'd like to show you the number of companies that are involved in retail, but we will save that for another slide. The next item that we would like to highlight after consumer spending is low interest rates. Dondi mentioned that all the measures have been put in place to ensure that the economy will have traction, will have legs to recover from this pandemic, from the lockdowns that the economy suffered. And one of the hardest hit sectors was the property sector. As you know, the property sector, at least the ones that we track, have 3 major businesses: office, residential, and retail. Retail, as you mentioned in the previous slide, almost completely disappeared during the pandemic. But what about residential sales? Residential sales of the major property companies declined by at least 50% for the year. Understandably, because agents could not go out and meet their clients. Take note that construction activities also were put to stop for a good 5 months. Therefore, all projects that were being built during that time, the delivery and the completion of those projects will have to be delayed moving forward. So that is actually one of the concerns of the market on the property sector. But thankfully, the office space was a comfort zone for the property sector, because if you notice, BPOs were allowed to operate, and most offices remained open as well, but in limited participation, especially because we have to observe physical distancing. But low interest rates, we believe, will pave the way for the revival of the property sector. Low interest rates will encourage more people to buy their homes. And our comfort for saying this is, the Philippines continues to possess one of the sexiest demographic profiles. We have a very big middle the people who are aged between 20 and 40. I believe this would be the marrying age, 20 to 40, kind of later for 40s. But family formation will ensure that demand for housing units will remain strong. Couple that with low interest rates, then we believe that the property sector will have an opportunity to recover on the residential side. Retail, discuss about that. Yes, we feel that the entire property sector is bound to recover, not this year, but starting 2022 and beyond. And let's take a look at how our favorite property companies fared. SM Prime owns the largest malls in the country. It ended at 3850, and it's just about 10% from its pre-COVID high. Ayala Land, owner of the most valuable tract of land in the country, Ayala, Makati CBD, and Fort Bonifacio, lost about 23% compared to its previous pre-COVID high. Robinson's Land is about 34%, and Mega World is about 37%. Moving forward, we think that low interest rates will allow the property companies to recover some of the lost ground that we saw in 2020. Again, it will not be quick and immediate, but the time to move into the sectors is now. Next, on the low interest rate, low interest rate scenario, we believe that the banks will also have its own share of recovery. Dondi talked about the NPLs of the bank. We are a bank. We know that business will be tough moving forward. We know that NPLs probably are just, or bad loans are just probably halfway to its actual number. But we should be comforted by the fact that Philippine banks are one of the safest banks and strongest banks in the world. I think we've had our lessons late in the 90s. Those of you who were around still remember the Asian financial crisis. Thanks to the prudence of our monetary authorities, our banking sector is now is strongest as it has ever been. Let's take a look at the banks that we follow. BPI and BDO lost about 30% from its pre-COVID high. And Metrobank is just trading at about half of what it used to be. We think that as the economic recovery, as economic restart takes shape, people, investors will have to look at the banks because banks are pillars of economic growth. When businesses need funding, they come to the bank. They come to Metrobank. The banks, we are ready for this recovery phase. But take note, banks, it's not going to be an easy business for us, but we think at this level, you can only see higher valuations in the next 2 to 3 years. Moving outside of the low interest rates and consumer spending theme, we're quite excited as well about the power outlook in the country. For the power sector, our play is green. We believe that green is the way to go. By green, we mean renewable energy. And I think there's a move of the government to increase the portion of renewable energy in the total energy mix. I think the move is to have about 30 to 40% of total energy capacity of the country produced via renewable means. And so you will have more solar, more wind. Again, it's more than just an advocacy. We believe that this is the way to go. Produce clean energy. And let's, unfortunately for our market, we can only highlight 2 names. That would be FGen. First generation is plain and simple renewable. AC Energy, it has a little bit of coal, but we believe that given the way that the company wants to move forward, it will do away with coal, and it will be an entirely renewable energy producer in the country. So, as you can see, FGen only is still close to its pre-COVID high, and we think it can only be upside from here, from these 2 companies. Next would be telcos. Wow, I mean, work from home, learn from home, pray from home. I think but the pandemic taught us to do everything from home. And that, in our view, will continue to be the sustaining growth story for telcos. Yes, PLDT and Globe were probably the two of the more resilient names during the pandemic, during the ECQ. But moving forward, we believe the situation will not change much. I think there will be more houses that will be requiring more stable internet connection. I hope my video is getting to you clearly. And so that is our story for the telcos. PLDT is down 60% from its pre-COVID high. We don't think the share price will go back to 3,400 immediately, but we think at 1,340, there's very little downside now for PLDT. Globe was quite stable, not as bad as PLDT. Again, very limited downside in our view. Converge was a brave soul last year. It listed at the time when, I think sometime in October, and right now it's still below the IPO price. So in summary, I think there's really not a sector that we do not like in the market, but we believe that some sectors will be moving faster than the others. And so this will be your guide towards navigating through the stock market this year. And we in Metrobank are here ready to help you. We have different forms of UITFs that will help you have a piece of that action in the stock market. The balance fund, we will have the best of both worlds, as the fund has a combination of fixed income and equities. Clearly from our message to you this afternoon, this fund will be more heavily tilted towards the stock market. Then we have the index tracker fund. If you are a starter, you don't want to take, you simply want to have an initial feel of how the market will affect your investment, then the Metro Philippine Index Tracker Fund is the right fund for you. Then the Metro Equity Fund, this is our actively managed fund. Again, the difference between this and the Equity Tracker Fund is that this fund can invest in non-index issues, whereas the Equity Tracker Fund can only invest in the 30 names which comprise the PSE at the moment. And then the High Dividend Fund, essentially the mandate of this fund is to focus on names that pay out high dividend. So last year, when the market had a very big fall, this fund was the most resilient among our funds. So friends, again, so offshore, you can also access or have the opportunity to go through the offshore UITFs of Metrobank. We have a global feeder fund that is invested in all parts of the world, definitely, majority of that in the US, the Eurozone, a fund that is focused in the Eurozone area, and then the Japan Equity Fund. So if you're a first-time investor in the UITF, kindly go to any of our Metrobank branches, the branch nearest you, and our personnel will be more than happy to assist you. If you are already if you're already invested in a UITF product with Metrobank, then all you need to do is access Metrobank online and you're good to go. But one more good news before I go, sometime late this year, we will be offering you the opportunity to open a UITF account as long as you have a Metrobank account. So there you have it. We think that this year will be the year for the stock market. Today we had quite a big fall, but you can almost see the excitement of people. As soon as the market fell, people quickly snapped up what they can buy. We hope that you will have a fruitful investing journey, and your friends here in Metrobank will be more than happy to assist you in whatever way we can. Happy New Year. Thank you very much.
Thank you very much, John, for sharing your insights in the equity space for 2021. Now we know that the PSEA target is at 8,000, driven by a 30% earnings growth. Very impressive. And another thing, which is also what Dondi mentioned, that the current low interest rate environment will not only benefit the economy, but also the listed companies as well, since after all, they are the ultimate proxy for the PH economy. So we now move on to our much awaited Q&A portion. Just a reminder that we will be able to accept questions until 2:55. So please key in your questions already so that the panelists will be able to answer your questions. So now we can start with the Q&A portion. So we now request John and Dondi to please turn on your cameras again to answer the questions of attendees. I think we have a first question already, and this one is for Dondi. Let me just read the question. Dondi, a question from one of the attendees is, do banks have sufficient capital to absorb bad loans?
I guess the general answer to that is yes. Like John mentioned, we're probably among the best banks in the world, given the very strict requirements of the central bank. We have higher capital adequacy ratio requirements, but it's uneven. Some banks are better capitalized than others. If you recall, in the last 2 years, some banks, including Metrobank, BPI, and I believe RCBC, did what you call stock right offer that increased their capitalization, but not every bank did it. So some are better capitalized than others. But in general, banks are capitalized enough. I guess the bottom line is we have to see how much bad loans really come out. The problem is last year that they had the Bayanihan 1 and 2, which where we saw loans not being processed or not being collected from. So we don't know the true story of non-performing loans for 2021. So bottom line, yes, they're capitalized, but it depends on how bad the bad loans increase.
Thank you for that, Dondi. That is reassuring to hear. And by the way, we would like to request everyone to please answer our survey by scanning the QR code flash on the screen or clicking the link posted in the chat box. So again, we move on to the next question, and we have one for, I think this one would be suited for John. John, the second question from one of the attendees is, are the listed companies prepared for a more digital world moving forward?
Yes, I believe so. No? I think even before the pandemic hit, I think businesses were already aware that the most efficient way to sell products, to deliver services, will be via the digital platform. And I think the pandemic was an accelerator of that. So moving forward, I can't imagine how you can sell, how you can move your products without being in the without the digital format. So my answer is yes, all forms, especially the banks, property even, and especially the food counters. Thank you.
Thank you, John, for that answer. We have another question. This one is for Dondi. One of the
Go ahead.
attendees is asking which investment is best right now, given the fact that we are in uncertain times.
Well, like I mentioned earlier, the people who are, how do you call it, segurista, like to stay in time deposit and bonds. But like I said, the risk there is over time you lose purchasing power because interest rates are lower than inflation. In fact, we want to be more bullish equities, but yet we only increase the equity from 21% to 47% and are still maintaining 53%. I think you still have to have a balance of both fixed income and equity in your portfolio. I think given uncertain times, it's better to leave the money with professionals by investing into a UITF instead of individual stocks because, like I said, the growth is uneven. Even among sectors, it's uneven. So it really is advantageous to take advantage of professionals running the fund. versus individual investors. Thank you.
Thank you, Dondi. And we have another question about the financial sector. I think this is for John. John, the question from one of the attendees is, what do you think about the smaller players in general, such as Security Bank and East West?
Yeah, the view on the banks is really for all. We merely highlighted the big three banks, but I think we were in the same situation as everyone else, and so everyone will have again the lost ground to recover, given the conducive monetary conditions that we have right now, and the government is espousing. I think they're really helping the banking sector get back on its feet. So yeah, the other banks, I don't want to refer to them as the smaller banks, but the other banks, as I said, will have its own piece of the recovery. I believe Security Bank and East West would be more geared towards consumer portion of the market. Yes, as the economy recovers, there will be more confidence now. So, yep. So, stay tuned. Yeah.
Thank you, John. And another question for Dondi. What do you say to those who advise to buy gold or cryptocurrencies rather than time deposit using their hard-earned money? So I guess just to paraphrase, the question is, what do you think about gold and cryptocurrencies right now?
I think the problem with gold is almost at an all-time high, no? Likewise with cryptocurrencies, they behave differently. Gold is negatively correlated with the US dollar. So for gold, we're not as bullish. What cryptocurrencies have for it going is its limited supply. In fact, it's stagnant supply. I think the problem with gold and commodities in general and cryptocurrencies particularly is the high volatility. So I don't think you can compare time deposit to cryptocurrency because the volatility on time deposit is nil or none, meaning you're almost principal guaranteed. Versus cryptocurrencies, the volatility is even higher than stocks. It's probably north of 20, 30, maybe even 40%. Having said that, I believe in the benefits of all asset classes, including cryptocurrency, and I believe that it should be a small portion of your portfolio. You cannot have 100% of your money in any one asset class, more so if it has that kind of volatility. So it has a space within a portfolio as an alternative investment.
Okay, thank you, Dondi, for your insight. We have another question here, and this is for John. John, one of the attendees is asking, he is currently a new equity investor. So he's asking, should he invest in the tracker fund or the managed Metro equity fund, or should it be a combination of both? What do you suggest among the products that we offer?
Yeah. Thank you for that question, sir or ma'am. We designed the tracker fund for new investors because we believe that investing in the tracker fund will allow you an initiation. You will have your first feel of volatility as the PSCI goes up, the value of your investment will go up with that, and if it goes down, the same with your investment. As opposed to other funds which are actively managed, the fund manager, let's face it, may not always be right. So therefore, if you track the movement of your fund versus the benchmark or the PSCI, it may have a different story. So for first timers, for newbies, for rookies, we suggest that you go for the tracker fund.
Thank you again, John. We have another question for Dondi. Is this the best time right now to secure a bank loan?
Okay, securing bank loans is not a matter of, well, definitely interest rates play play a role in it, no? If you have use for a bank loan, then yes, because interest rates are low, this is the best time. However, if you're not going to be able to use the money to expand your business, then it's useless. In fact, what we saw last year was we saw a lot of companies pay in loans because they couldn't really expand last year because business wasn't looking great. But if your outlook on the economy is it is going to start improving, then it is a good time. Like I said, we don't expect the economy to go back to pre-pandemic levels in 2021, though. It will probably see the economy go back to 2019 levels only in 2022. So
Thank you,
bottom line, as long as you have a use for it, then it's good.
Thank you, Dondi, for that. We have another question for John. John, do you think that the growth story of telcos and broadband services will continue substantially, given that the PSE is planning to include a mini index for media, telecoms, and IT services?
So I think that was towards the tail end of our outlook. We think that the story will remain the same: demand for data, stronger coverage. I think you will have people willing to pay up for better service. So that really is the backdrop of the future of telco in the country. I don't think the inclusion or the addition of a telco, whatever that sub-index, will have a big impact on that sector. I believe the market's really open for more players in the sector, which will benefit consumers like us. But essentially, I think we haven't really seen the full play of the post-COVID world, where business, we don't know how much of the workforce will remain working at home. We don't know when classes will start physically getting together. I think for the whole of 2021, safe to say that students will continue to learn from home. So with that backdrop, you have again, maybe the word substantial may probably be not the right word, but what we'd like to how we'd like to illustrate is perhaps it will be a sustained growth for the telco operators. Thank you.
Thank you, John, for answering that question. And it's almost 3 p.m., so we have time for one last question, and this is for Dondi. Generally, one of the that is asking, what are your views on REITs, or real estate investment trusts?
Okay, REITs are different. It's a different, it's classified as equity, but for me, it's a unique asset class. It's like a hybrid in terms of classification. It's equity. In terms of performance, it trades more like a bond. So it's almost like a preferred share with a declared dividend yield, no? But unlike a preferred share, the dividend yield changes. How does it change? It changes based on underlying interest rates. If interest rates go up, the price of the REIT theoretically should go down. And the second biggest factor on REITs is occupancy rate, no? The problem right now with the REITs in the market is the occupancy rates are close to 100%. The moment they have vacancies, that will affect the price of the REIT. So when you look at the REIT, the things you have to look for is the quality of the lessors, of the people renting the property. So like John mentioned, there's concern about POGOs, at least in general. So in general, REITs that have POGO-heavy renters might not perform as well because there's a chance that occupancy rates might go lower. So if you look at the first REIT that came out, Ayala, none of the renters were POGOs. They were BPOs. They were stable companies. So those are the things you look at. So again, it's a good asset class to have in your portfolio. It's a hybrid between equities and fixed income. But unlike fixed income, the declared dividend yield changes. It changes based on occupancy rate and underlying interest rates.
Thank you very much. And with that last question, we'd like to thank John and Dondi for sharing your knowledge and equipping us with the financial tools we need in facing 2021 with much more optimism. We'd also like to thank everyone for joining us this afternoon. And of course, for those who have asked questions, because they have truly enriched our discussion today. But before we end this session, we'd like to request everyone to answer our survey by scanning the QR code flash on the screen or by simply clicking on the link in the chat box. And with that, we will conclude our program. On behalf of the Trust Banking Group, I am Carlos. Thank you, stay safe, and Happy New Year.
Cheers.